stock market halfway around the world just lost $270 billion in 48 hours. You were about to scroll past that, weren't you? Don't. South Korea's KOSPI. That's their version of India's Sensex. Crashed 15% in just 2 days. And the companies leading that free fall weren't some obscure names. We're talking Samsung and SK Hynix. Together, they control 67% of the world's DRAM supply. Those are the short-term memory chips inside literally every laptop, phone, and server you've ever touched. And nearly 80% of the revenue from HBM chips, the ultra-fast memory that powers AI systems like ChatGPT. Think about that for a second. Imagine 2 factories in one city produced 80% of the world's steel. Now imagine that city just had a major crisis. That's exactly what this is, except the steel here is the raw material fueling the entire global AI revolution. Now here's where it gets even shakier. South Korea imports 97% of its energy, almost all oil and LNG, from the Middle East, shipped through the Strait of Hormuz, one of the most geopolitically volatile shipping lanes on the planet. These chip factories are extraordinarily energy hungry. Any disruption on that route, even a brief one, and you're looking at cost spikes or outright shutdowns. And the part that should genuinely make you nervous, global memory chip stockpiles are dangerously thin right now. We're talking just 2 to 3 weeks of DRAM supply sitting in warehouses worldwide, 3 to 4 weeks of NAND flash, the storage chips in your SSDs and smartphones. That's it. There is virtually zero cushion. One supply shock, one blocked shipping lane, one factory outage, and prices spike almost immediately. So no, this isn't a distant stock market story. It's a supply chain story sitting on a hair trigger. And in the next segment, we're going to break down exactly why South Korea ended up this exposed in the first place. Now, every crisis reshuffles the deck, and this one is no different. So let's talk about who wins, who loses, and what it actually means for your money right now. Let's start with the losers, because yeah, there are some. If you hold Samsung or SK Hynix shares directly or through any mutual fund with heavy tech exposure, you already felt that 15% crash in your gut. But here's the thing, the pain doesn't stop at your portfolio. South Korea imports 97% of its energy. That is not a typo, 97%. And when energy costs rise, manufacturing memory chips gets more expensive. Tighter margins for chip makers means higher prices pass down the chain. And that chain ends at you. Think laptops, servers, cloud storage, your SaaS subscriptions. If your business runs on any of that, and whose doesn't, you could be staring at higher technology costs somewhere in the next 6 to 18 months. Even Nvidia, whose AI chips depend on South Korean HBM memory, is already dealing with supply bottlenecks. Those costs never stay with the big guys. They always trickle down, always. Now, the winners. And this is where it gets genuinely interesting. Defense and aerospace firms. Think Hanwha Aerospace, Lig next one, are sitting pretty. Geopolitical tension drives military spending, capital rotates into defense like clockwork. And analysts are expecting these stocks to outperform for the next 12 to 24 months. Then there's the trend that our infographic is tracking. And it's a rising one. Alternative energy and infrastructure. South Korea's 97% import dependency isn't just an economic problem anymore. It's a national security crisis. And governments move fast when security is on the line. Expect accelerated investment in renewables, nuclear energy, and efficiency tech. That's a real, tangible opportunity for businesses and investors anywhere in the clean energy supply chain, globally. So here's your takeaway. If you're tech dependent, start auditing your technology costs today. Not next quarter, today. And if you're anywhere near energy, defense supply chains, or infrastructure, the tailwinds are building. But zoom out even further. And there's a whole other dimension to this story. Demographics. AI adoption, a society in rapid transformation. That's exactly what we're getting into next. So where does this all lead? Let's cut through the noise with 2 analogies that actually make this crystal clear, and then talk about what you should do about it. Picture a champion Formula 1 car. Fastest machine on the track, absolutely dominant. But it runs exclusively on a rare imported fuel, delivered through one single narrow mountain road. That car is South Korea's AI chip empire. 67% of global DRAM, 80% of HBM revenue. The fuel is Middle Eastern oil and LNG. The narrow road is the Strait of Hormuz. And here's the brutal truth. Even the best car in the world loses the race if its fuel supply gets cut off or becomes too expensive to use. That's the structural risk investors need to price in right now. Now, second analogy, and this one hits differently. Imagine a major city with only 2 or 3 days of food left on supermarket shelves. Nobody panics on a quiet Tuesday. But the second one highway gets blocked, shelves are empty within hours, prices spike overnight. That is exactly where global memory chip inventories sit today. 2 to 3 weeks of DRAM, 3 to 4 weeks of NAND flash, zero buffer. One geopolitical flashpoint, one factory shutdown, and your technology costs spike before you even see it coming. So what do you actually do with this? If you run a tech-dependent business, seriously consider locking in longer-term contracts with your hardware or cloud vendors now, before the price hikes arrive. If you're an investor, the alternative energy and defense sectors in South Korea have real structural tailwinds that could run 3 to 5 years as Korea pushes hard to reduce import dependency. And regardless of who you are, keep one eye on chip price signals and KOSPI volatility. Those are your early warning systems. The bottom line, this is a live stress test for the global AI supply chain. And the cracks being exposed right now are not going to be patched overnight. Follow us for more updates like this. Thanks for watching. And don't forget to follow us on YouTube, Instagram, and X.